You think investing means finding the right stock, the next Nvidia, the next Tesla, the one company that quietly makes you rich. So you wait, you research, you hunt for the winner before everyone else sees it. Here's the problem: the people paid to do exactly that, full time with entire teams and billions on the line, mostly lose. Let me offer you a different idea instead, one that sounds almost too simple to work. You don't have to pick the winner, you can own a piece of the entire race. But before any of that makes sense, you need one word, a word everyone uses and almost nobody can actually define: an index. Let's start right there. Strip away the jargon, and an index is just a list. A scoreboard for a group of companies. Take the most famous one, the S&P 500. It tracks around 500 of the largest companies in the United States. When someone says the market is up today, this is usually what they mean. That scoreboard moved higher. Now picture the race again. The index is the leaderboard. It doesn't run in the race itself. It simply shows how the whole group is performing at once. Maybe you've heard the market 100 times and nodded along without really knowing what it meant. Now you do. But here's the catch. You can't buy a scoreboard, you can't own a list. So how do you actually get a piece of the race itself? That is where the index fund walks in. An index fund is simply a fund built to copy an index. Instead of buying one company, you buy a tiny slice of all of them at once. Come back to the track for a second. Instead of betting everything on one horse, you quietly own a piece of every horse in the race. You stop guessing which company wins, you own all of them, and you take whatever the group delivers. In other words, an index fund turns investing from a guessing game into an ownership system, which raises an uncomfortable question. If owning everything is really this simple, why do most professionals lose to it? To understand why they lose, you have to start with a belief, one that almost every beginner shares. The belief that winning means finding the right stock before the crowd, spotting the genius pick early. I call it the stock picker's mirage. And it's one of the most expensive beliefs in all of investing, because to actually beat the market by picking, you don't have to be right once. You have to be right over and over again. Pick the right company, buy it at the right price, hold it long enough, sell at the right moment, then do the whole thing again. For years, miss one single link and the entire chain breaks. And this isn't just theory, it got tested. In 2008, Warren Buffett made a famous bet. Buffett chose one simple index fund that tracked the S&P 500. On the other side, 5 funds of funds, each one spreading money across many hedge funds. 10 years. Some of the best minds on Wall Street against a fund that does nothing but own the market. The result wasn't close. Over the decade, the index fund returned about 126%. The 5 hand-picked funds of funds averaged roughly 36%. The boring option didn't just win, it tripled them. The goal was never to be the smartest person in the room. It's to stop playing a game most people lose. So if you've spent your weekends hunting for the perfect stock, consider this your permission to stop. Because even when you own the whole race, something is still quietly stealing from you while you do everything right. It's called a fee, and fees look almost too small to matter. 1%, half a percent, 0.03%. Numbers that tiny feel like a rounding error. They're not. Think of it as a tiny leak in your portfolio. You never see the money leave. No bill arrives, no charge hits your account. It just quietly drains your returns year after year while you sleep. I call it the silent tax. And let me show you what tiny really costs. Picture 2 investors. Same $500 a month, same 30 years, same 7% before fees. One pays almost nothing, around 0.03%, close to what some of the cheapest broad index funds charge today. The other pays 1% a year. That's the only difference between them. After 30 years, that single difference opens a gap of almost $100,000. And remember, you personally put in $180,000. So the gap the fee carved out is bigger than half of everything you contributed. The most dangerous fees are the ones you never feel. And yet, as brutal as that is, fees still aren't what wrecks most people. Because the biggest threat to your money isn't the market. It isn't even the fees. It's you, your own mind. And here's exactly how it happens. By now, you've done the hard part. You picked a broad index fund, you kept the fees low, so you're done, right? Not quite, because the hardest part was never buying an index fund. The hardest part is holding it. Here's what happens to almost everyone. When the market climbs, you feel smart. You want to pour more in right at the top. When the market drops, you feel sick. You panic and you sell right at the bottom. And this is why the real gift of an index fund isn't only the diversification, it's that it quietly removes the decisions that hurt you the most. An index fund doesn't make you smarter. It just gives you fewer chances to do something stupid. If you've ever sold in a panic and regretted it weeks later, you already know this is the part that truly matters. So if the strategy really is this simple and the only real enemy is your own nerves, how do you actually start? The good news is you don't need much. You don't need 20 funds. You don't need to watch the market every day. And you don't need the perfect moment to begin. The whole thing really fits into 5 steps. 1, open an investment account. 2, choose one broad index fund, something that owns a wide slice of the market. 3, decide how much you can invest consistently. 4, automate it so staying invested isn't a decision you have to win all over again every month. 5, then stay patient. That's the hard one. And the amount itself, maybe it's $50 a month, maybe $100, maybe more later on. It matters far less than you think, because in the end, the amount matters less than the habit. And that one habit repeated for long enough is really the whole secret. So let's go back to where we started. In the beginning, you thought investing meant finding the next big stock, the one winning horse. Now you can see the other option. You don't chase the winner. You own a piece of the entire race, and then you let time run it for you. It isn't loud, it isn't exciting, and that is exactly where it's power high. The market rewards the people who stop trying to outsmart it and start giving time the chance to work. Tell me in the comments, are you already invested in index funds, or are you still thinking about starting? And if you want money to finally feel like a clear map instead of a confusing mess, subscribe to the Money Roadmap. And if this video helped, watch this one next. It breaks down the 7 levels of wealth and shows you where most people get stuck. I'll see you there.